excuse me, we distinguish between sweeps. Sweeps are order IDs defined by the single order ID, which is needed, and they can only be displayed in MBO data feed and the non-MBO data feed, like here Apple. Let me see here this number here. Here, that's a volume spike at the beginning. 580,000 contracts have been traded at 150 at the beginning. That means that needs time. Within 1 second, it was a really strong volume spike here in Apple at the beginning, and that's the difference. We are how we differentiate between sweeps, stop runs, if you want, and volume spikes. And as you, Argus, mentioned here, when we look at the ES.
So Walter, that 580,000 is not one order ID.
No. We can't. We don't.
Can't
Yes.
do that. Okay.
Yes. There's a difference. If you see sweeps, then you are seeing. You will see sweeps only with MBO data. That means Rithmic or Denali. I think Denali is the same one, but we haven't tested that yet. And for Bookmap, of course. And if you don't see sweeps in an instrument like stock, like Apple or whatever stock you are trading, or ETFs, then you will see volume spikes. And volume spikes, as I will explain a little bit in a few minutes, are a little bit different because we don't have MBO data. We don't see a sweep. We need the time and the volume transacted. That makes therefore we call it volume spike here. Coming back to the documentation, just to make clear what I'm talking about. What are sweeps? Detectable only with MBO data feed, big aggressive market orders, trading through one or more price levels. So they leave a vacuum behind. So what you see here in my chart on the documentation or live when you zoom in, you see a black area here. So this is simply the timing of the incoming data, what you see these red bullets, because normally they should be along this green line here. But it's not, simply that's the synchronization of the incoming data. And you see a black area here. So that means it takes time. It takes time simply to for the book. The book is empty in that moment, and it takes a little bit time. Look here, the liquidity comes in back in. So even don't know if it's measurable. 53 in 1/10th in 1/10 of seconds here. So that in this case the book is empty. There's nothing because they consumed everything in the book here. And Chris, we will talk about the possibilities and probabilities taking the sweep, taking counters to counter the sweeps. The difficulty we have, excuse me?
So Walter, going back, can you make that thing again? The black thingy. Okay. So basically, it consumed 1,000. So they placed an order for 3,000. Mm-hmm. And they were able to get only 1,206, and that black area pretty much that much, right? 1,206, and still that 1,700 it has to go through the regular book.
In this case, yes. In this case, yes. On the other side, when you watch when you see the documentation, you will see an iceberg of exactly the same size as 854. In this case, you will see we have different behaviors based on the sweeps. So he wants to get 3,000. And I'm just my documentation, page 49 right now, as you see on my screen, hopefully. And he actively got 2,146 contracts. He traded through 16 ticks. R mean price. Price is 16 ticks. In this case here, live case, means R price 9 ticks. That means 2.25. So he traded 2.25 and ended at 46.90 in this case. And he got 2,146 and he didn't get 854 contracts. That means in order to close his trade, he need to buy back 854 contracts, either by an iceberg or, like here in the book, based on the passive order or the limit orders here, as I think it was Argo who mentioned that. There are different techniques to work and to see what's happening, and what sweeps really are. So they are basically algo-driven, fast, extremely fast moves. You will be surprised every time when the sweep happens, because we can't predict sweeps. They are leaving a vacuum behind. You see this black area. They are trading a certain amount of contracts. We can differentiate between active and passive and the price traded. And if sometimes you will see 3,000, then he will get 3,000. But if this trader here, don't get 3,000 in a row, then he must buy back the remaining rest, in this case 1,794, and it can do that by icebergs, or he can do that because there have been 1,794 in the book on the limit side to accomplish or to finish his order here.
Walter, I'm kind of losing on buying back. So he placed a sell order. So how he will buy back that much?
Because there, in this case, in this example, he buys back based on the passive, on the resting liquidity here. You see?
He will place a buy order then. For those? Or is he going to place?
No. Look here. What? Maybe that's a good point here. Where my cursor is. When you exactly what Chris is saying. Look here. 1,300 at that point at 46.90, they have been passively traded 1,337 contracts at 46.90. You see where my cursor is? You see the dome?
Yes.
Yes. So he bought back what he tried to sell here. That's the meaning of passive. That's the meaning of passive. He actively sold and bought back passive.
Okay.
I mean, why are we talking about that? Because you should understand the difference between volume spikes and sweeps, because sweeps are mostly there. I will, as I promised, to discuss the stop run issue again with you, and what I think, or what we think stop runs are. Oh, there's another one. Let me just see. There's another one. I see that right now here. Oh, that's a nice one here. So this guy, let me say that here, this guy sold 1,000. What was it? 1,200 and bought back 1,794. And then a few minutes later, 50 and 5 minutes later. Oh no, look here. I'm sorry. I'm really sorry, guys. I missed that. Look here. I'm sorry. I missed that. you see 1,794, and you see these icebergs 9,794 here. He covered here as well. That's what I missed here. I thought they covered everything here on this price, but you see the iceberg traded. You see this big bullet in the hidden order plot, and this big bullet here, 1,794 traded here. So you see the match 1,794, and we can trigger we can analyze these icebergs with 1,794. He bought back via iceberg 1,794 contracts. Not sure all the time here when the market went bad, but his order was finished there. Let's have a look at this one. That might be a little bit easier to understand. The sweeps. So, same situation as before. He wanted to sell 1,422. Chiara, just give me a second. Yes, he covered his position completely. Let's have a look at this iceberg. Very fast, went to 6 ticks. He actively traded 693 contracts and passively 729. The sum is 1,422. And what happened then? He placed an iceberg on ask, which size was 729. And that means his trade is closed. Perfectly traded. He got 693 contracts within 6 ticks. So,
but he still has those 693 shorts.
Yes. What can we learn? What can we conclude out of this behavior? So again, 1,200. He is short. Let me see. He is short 1,206, and he is short 693. So yes, 19. He is short 1,900 contracts. He short 1,900 contracts at this point here.
So one technical question. In BO, if we take a look at those two sweep orders, they probably are with the same IDs also, but with the 5-minute difference.
Yes. No, excuse me. They are different. They have only one. The sweep is included in the data string only with a single order ID, but the IDs are not the same.
So the different order than with the different ID.
Yes.
Okay, but there isn't information about who sold it.
No.
Transactor ID. Okay.
No.
Got it. Mm-hmm.
Chiara, what do I need to install to see the sweeps? It's a part of the Trade Finder, so you don't need, in case you have the Trade Finder, you don't need anything. It's built in the software, so we are not analyzing sweeps based on MBO data. If you check the Market Explorer, you can set the size you want to see. I set my size to 600. That means every sweep which is bigger than 600 or has at least 600 contracts and more will be displayed on chart, because I'm just interested in the big ones. What I want to tell you is I want to see. First of all, I want to make money, and I hope you will make money too after these days with me and with us here. Second, I don't want to see any iceberg, because from my point of view, it's not meaningful. I don't want to see any volume spike, because I want to see the volumes, the swing highs and the swing lows. That's what's of interest. And as well, this big sweeps here. It gives me an idea that there is a big player who is either positioning themselves short, or he is hedging. But to hedge the amount the market normally needs, we are talking about billions, millions and millions of dollars. I doubt that this is hedging. I don't believe that this is hedging. Simply, I don't believe that. Because when we are talking about options and hedging, we will see that the big hedgers, if the delta of the prices rise for 1%, they must hedge at least 500 millions of shares. So that's really, it depends on the price, it depends on the instrument. I will discuss an example with you. I don't believe that this is a hedge. The most probable idea we developed is that this is a big guy who is really he better informed than we, and he is trying to sell. Even if he is 2,000 contracts short here. Even if he is 2,000 contracts short here. You can do the math. It's quite easy. When the price drops, let me say at 84 or 80, he makes a huge bunch of money here. And because he can't get, he wants to sell 3,000, try to sell 50 contracts in a row. Try to sell 50 contracts in a row. What happens? You get you will first of all, you will maybe try to sell 50 contracts in queue. You will maybe get you will get a worse price. Your enterprise will be the average, and that's what you don't want to have. So the same is in ES E-mini, if I'm talking about ES Mini. Therefore, we need the SPX, or the hedge funds and the institutions are using the SPX to hedge, or Apple and all these high liquidity instruments, not necessarily E-mini. However, the SPX has an influence on the SPY, and the SPY has an influence, or it's a one-to-one correlation to the ES Mini. So if something happens in the SPX, we will see the outcome and the result in the E-mini as well. That's as well valid for the QQQ and NQ, if you are trading NASDAQ, for example. So therefore, my theory and our theory in our room, based on our developers, Doug and Rick, is that this is not a hedge against rising prices. That might be, and that's really, guys, that's speculation, that might be some big player who is positioning himself to maybe he knows or will see that the prices are going down, and he can sit on this position and let the market go against him. He can sit, and he will sit. And mostly, that's the phenomenon if you are using the Trade Finder. Most of the day, you will see when the session ends, you will see at the end of the day icebergs covering 3,000, covering 2,000, covering 1,500, and that is a good indication that this guy or this guys here who are selling in this case are covering their position, maybe at the end of the day, or maybe during the night session or pre-session. He can sit and wait until the price comes back. I doubt that I could do that, because if I'm selling 2,000 contracts, maybe I don't care, because if I'm losing 1-2 million, then I for sure will have a big pocket to say, okay, that's okay, losing 1-2 millions here with trading or with the futures. Any questions to the sweeps here so far? It's fascinating, guys. It's really fascinating, and I will show you what strategy we could build around it. We measured. We did back tests on sweeps. I will just let me tell you what we did. We did. We took the sweeps account. We did a counter trade. And when a sweep happens, we go against the sweep. And we wait until the market comes back and retest. That's an, I'm sure that's a divergence here. Maybe, yeah, that's a divergence here. See that? That's an exhaustion, again, exhaustion here. And what you can do, what we tested, is that this sweeps could be traded against. And we, no, sorry. We invented the usage of so-called B-lines. We are testing them. Maybe we will bring up in the next Trade Finder, excuse me, in the next Trade Finder version. You see how come on, what's here? You see how hard it is to draw lines here. So Chris, I just want you know that if this is that's not a stop run, that's simply selling here. He wants to get 3,000, 1,400. You can go against it. The first tests with back tests are showing a result which is below 50%. So this is not a holy grail here, but it's a fair chance to trade against a sweep. Against a sweep. Or if you are not sure to going this way, we will introduce lines. We call it so breakout lines or B lines, where when the sweep started, a line is drawn here on the upside where the sweep started, and to the downside. No, that's not correct here. Sorry, that's not correct. Now, how can I? Okay, come on. That's really bullshit. Rectangle. So the sweep started here and ended at 9T. Ended here. You must be very precise. You must be very precise with that. Let's say 92 to 9T roughly. Oh, no, it's not correct here. Anyway, really annoying here a little bit.
So the sweep, like this box will come up, like, I mean, at the sell sweep at 9,4,690 will come up like on the immediately, or it will be.
No.
I mean, yeah, it takes time to pop up like this.
No, they come immediately. You won't be able in any way. That's the problem. That's the problem with our backtesting. To go against a sweep, to be very open when a sweep happens. Not to be very open, but that's the characteristics of the sweep. When the sweep happens, let me just erase this. It's a little bit really annoying here. When the sweep happens, let's zoom in. When the sweep happens, then the first reaction should be, okay, we should go against the sweep. But this is so fast. And when it trades into 90 and indicates by this flag, by the signal, that's the end of the sweep. You won't be able to take a trade there. It's not possible.
So Walter, the flag throws at the end of the sweep?
Sorry?
The flag is displayed at the end of the.
Yes.
So, but remember, at that point he only got 1,200. He didn't get full.
Excuse me,
Then
again, the flag is drawn at the end of the sweep, yes, and then? Repeat it, please.
but he only got a part of his contracts.
Yes,
Oh, it shows,
Yes.
and it shows with the active and passive. Okay,
Yes.
it throws with the active and passive. Okay.
yes. He got only 1200 in this case. And he tried again, few minutes. Later,
Then he used a different mechanism.
he used the same mechanism.
Same mechanism.
He placed an
Okay.
order for 1,422 contracts, swept through the book for 6 ticks, got 693, and that's all what he got in a row here and here. That means let's say that's the same institution, same guy. Now he is short 1,900 contract. He is now short 1,900 ES future contracts, ESE mini future contracts. So to be very precise, the question was raised by Chris, I think. How should we treat and trade sweeps? And my answer is that we are backtested sweeps. And the backtesting showed that the sweeps, the successful trading against the sweeps is below 50%. Especially when you are trading manually. First of all, I'm not sure who it was. I think Argo. It was Argo, who's mentioned this is so fast. First of all, you can't predict sweeps. You can't see behind the algos. They are happening very fast. And then the market comes to a break, and when you realize that this is a sweep, oh, that was a sweep, I have to go against it, the market is far away here. You won't get 46.90 here as well. You won't get this number. By the way, just in this case, when we are talking about this, you see the sweep ended at 46.90 and the sweep ended at 46.90 here as well. That's fishing for contracts because he wants to go short or to be short. We will see what happens at the end of the day. He might be as well wrong, so that's not a guarantee that the market will drop fast, very drop lower or trade lower very fast. That's not the story behind. That's not the story behind. But you can read what market intentions are. You see how he is covering the passively 1,794 and closing this order, and you see how he is covering passively 729, covering here, or MASS closing his order here at 46.90. The strategy for sweeps, the best strategy for sweeps, I think is, and we are discussing that, and as I mentioned, we will bring it up in the next releases, is to draw a line where the sweep starts and when the sweep ends at 46.90. It's not a line, it's a rectangle, it doesn't matter. But you hopefully have the idea what's this good for. So to mark a sweep start and a sweep end and looking for a breakout could be a strategy. Excuse me, that's really could be a strategy. We will talk about the strategies, but where I will show you for sure better ones, but you should be alerted that this is something meaningful in the market. This is really something meaningful in the market. Anything else is playing around and maybe speculating what's happening and what happens here. Let's see what happens. Well, where's the market right now? Oh, the market dropped to 85. Interesting. So he sold 90 into 90 to 1,900 contracts. Market traded at 994.95. Retested here, and then traded into the next liquidity 85. Still interesting. We have liquidity 700, 4700 and 4702, where this institution level was 1 hour before the open. Let me check that. Oh, 1. So that's the picture we have today of this market. It's impressively, ladies and gentlemen, when you what I would have theoretically done on NQ, because I'm not trading NQ, I would split the screens. No. Let me see if I can do this here on my Windows. Yes, I would have split the screens and see that someone is selling here. The sweep here is extremely interesting. Supported by an iceberg. I would have bought this one. It comes together with, I would always look in parallel. What happens in ES? I don't know, because I'm really unsure. So if I would for sure looking NQ in ES in parallel and see what happens on the NQ and ES. And by the way, when you are talking about NQ, I would strongly recommend to watch the QQQ as well. It gives you so many information. We'll talk about the SPY and the SPX in hopefully today, to understand what's really how this stuff is really working here. When you're trading NQ, watch the QQQ, watch the ES, and then you will have an idea what the NQ is doing. Is it better to use QQQ chart for trade? Yes, it is. It is better to start day trading with SES and after to do this with NQ. I would prefer the ES. If you are watching NQ, I suggest using QQQ. I suggest using FQQQ, and I think it's called NQQQ as well. Let's talk in the strategies. I would like to be a little bit more patient. I will come back when we talk about the strategies and about this correlated markets. You see how well the Trade Finder works as well here. You have the liquidity here. So I would watch, and I'm watching for the SPY, the SPX and others we will talk about, and then I'm making my decision based on what I see in Q. Okay, now we have the information that this is a big guy who is positioned short. We see that. Very nice with the sweeps, what is traded actively and passively, how he covered using the icebergs, which are matching this passive orders perfectly. The market goes against him. The market went against him, and he is still waiting to cover. Not sure what happens next, but he is still waiting, or he is still in the book, because we don't see any covering of 3,000, or in this case 2,900 contracts. Okay, that's what we talked about. Sweep tracking big players. Big aggressive market orders. The Market Explorer analyzes all sweeps based on market by order data. You won't see sweeps for Cedro. You won't see sweeps for Kinetic. You won't see sweeps for CQG, IQ Feed. Whatever you use, you won't see sweeps for that. We do identify big players by tracking the active traded volume, passive traded volume, and the price which has been traded. So we discussed that. That's a part of the Market Explorer. I think Yara asked that. It's a part of trading of Market Explorer. You can set, and you must set the volume based on the volume of the traded market volume. So all settings of TradeFinder are based on the instrument's volume, and you know the S has a different volume than the NQ or TF, Russell, or gold, or soybeans, or treasuries. Keep that in mind. Yeah, you can trade against the stop run. So that's the discussion here between Raymo and myself. Let me just find another example for a sweep. It might be an stop run. Yes, why this effort? Why do we do that? Because in our analysis, we be using TradeFinder with a different approach than Bookmap is using his SI tracker. Bookmap is using the SI tracker as a mathematical program, and you might see now and then that sometimes it works, but the question is, we want to make money, and we are here to make money. That's our first intention. I don't care about signals which causes a so-called noise on the chart, because that will distract me, and that will distract my inner monkey. We talked about a chimp yesterday, and I will show you a very, very exciting idea how to track the market direction. And when I'm in, I watch what happens on the market. I see the big sweeps. I'm alerted. I see the big volume, the big volume at 4700 ES, for example. And I'm simply focused to manage my trade, to trail my stops. So why this effort? Sweeps aid us to see where big players come into the market. They intend to sell, to buy, or to hedge a future market. We will never know why they buy or sell for sure, but we will recognize their intentions, and we can adjust our trading ideas for the day according to what we see based on their activities. That's the effort. It's not the effort to say you have to go against. We are testing that, by the way, as I mentioned. You should go against or with them. But this information here is so invaluable, so important to every one of us for active traders. When we see that the market went up very fast from 70, 76, 77, 78 into 90, that makes you or brings you 10, 12 points in a row extremely fast. Even if you only take the price dynamics plot here, because it's tested with the ES future. They went through the liquidity here at 80 like through butter, and then traded in 90. That means if you are long 78, 79, 80, or here maybe even, as Raimo mentioned, 76, go long, go long, go long. So you have the luck. So they are retested the 76, and then they are traded into 90. 10 points, 12 points, close UPC, enjoy your life. That's my advice. And if you want to stay around here, then the next level was this liquidity area at 95, and then this is happening. And then you should be a little bit more cautious with your position. We want to make money. We don't want to trail any single small signal on the chart. What is the logic in identifying sweep? If sell spike to the... No. Again, Christoph, a sweep is a single order ID. A volume spike, it leads to exhaustion, and that's the volume spike. That's the difference. That's the difference. we find based on our research. To trade volume or to transact on each price level, that takes time, right? I'm going back to this example at the beginning. I can annotate something. Let me see that. I can annotate here. To trade volume or to transact volume on each available price level, that takes time. Right? That's the price here, 67.78 into 78.50. It takes simply time. Takes simply time. No, how can I'm not really comfortable with this. It doesn't matter. So this is the price axis and this is the time axis here. Okay. It takes time, and that leads either to a volume spike, which we are measuring. So we need for 1 second, if the price and if we are trading 1,000 contracts in 1 second. That might be meaningful. It depends on the instrument. If we are trading 100 or 200 contracts in NQ within 1 second, that is meaningful for the NQ. If we are trading 1,000 contracts within 1 second in ES, that's meaningful as well. So every transaction takes time because the matching engine, and that's the point why we talked about the auction at the beginning, the matching engine must match every single order. I mean, it's electronically and it goes extremely fast, but it doesn't matter if it goes fast from our perception. It takes time. It simply takes time to transact. And clear our drawings. Okay. Coming back to volume spike, the volume spike takes time to transact, let me say 1,000 contracts in 0.5, 0.1 or 1 second. That's the difference between sweep. We don't have any controls over sweep. They happens because this is an algo-driven mechanism. We are simply not in charge of anything. We simply can identify them. We simply can identify them on chart. Here, we don't have any influence on them. They're simply happening. We can measure if there's, as I'm doing here for yes, or you can do that for NQ. I'm using 600. I want to see 600. Let me see what I have defined for NQ. 150. So I want to see contract size of 150 in NQ within at least 10 price tick or 10 ticks traded in NQ, and I want to see this 150, and then everything what is bigger than 150, 160 comes up in the chart and it signalizes that is a sweep. That is a single order ID which transacted with 168 contracts here, which transacted with 400 contracts here, and that's the far better number than only 100, 150. We want to see this sweet spots. We don't want to see anything in between. We want to see the swing highs and the swing lows. So, and that's the idea of volume spikes, because we have the measures of volume spikes are volume the time, excuse me, volume, the time, the price range, depends on instrument size, either it's a stock, then you should define 20, 30 cents or 50 cents even, so if you want to see the big ones. And the ratio is simply, we found out, is the ratio, if they trade up, then immediately they should be an counter move. So if they trade up, for example, in this example, if the volume is trading up, when the accumulation of the tip, happens, when the last volume is traded, we want to see a counter move. And we are setting the volume traded up divided by the volume traded in the counter move here. That's the ratio. We have had a lot of discussions. I don't want to raise discussions based on the ratio. If you are not happy with the ratio, set it to 2, but you can even filter volume spikes by raising the ratio to 5 or 10. It depends really on the instrument. If you don't obey the ratio, set it to 1 if you are using TradeFinder, and you will get every volume spike based on volume, time, and the price range traded. That's the main difference between volume spike and sweep. Any questions?
Walter, one question. Here pretty much sweep is, we do a counter move. Can you tell me why we expect a counter move from the
Yes.
market or liquidity standpoint? Why do you think that there is a counter move is so high probable?
Yeah,
it cannot happen every time, but why it's high probable?
Let me explain that. Because this move, it's not a perfect one, but anyway, it is because this move with its high volume traded leads to an exhaustion. That's the reason. We talked about Monday about the auction, and look here, this is the accumulation of volume here at 89.50. This is the accumulation at 89.50. You see this green bullets here on ask. When big volume or high volume, when high volume is traded in very fast, that means, let me show you that again here. I hope that works. So we have different price moves. There's the price axis and that's the time axis. Okay? The first move is grinding up. So grinding up, the price is going up and price is going up. It takes 30 minutes to raise the price for 2 points or whatever, 20 cents, $1. It doesn't matter what you are trading. Then we have a little bit accelerated moves in the market. So that means this move is a little bit faster. It's not really the exciting move, but anyway, when it goes up, it takes minutes and minutes and minutes and minutes, but the price reached by this move is about, let me say, 4 points or 6 points. The next move we have in the markets are a little bit more accelerated. There's a high pressure behind, so they are exciting. You will see market volume rising, and they are pushing the price. They're pushing the contracts. They're buying everything from ask. They're buying everything from ask, and the price goes up. And the last move that's the volume spike. I would like to say is this move. I don't know whether I can. Oh yeah. Let me say that's the volume spike here. That means when something is extremely fast, it goes within milliseconds or maybe 1 second, and it trades 1,000 contracts. That is a kind of exhaustion. I think Srini, you ask, yes, right? That's a kind of exhaustion. No, that's exhaustion. And at the tip of this volume spike, The price. Okay, my question now to you is just I want to keep you to keep you awake. What is needed given this volume spike happens? What is needed to move the price further up?
More market orders.
Sorry?
More market orders.
Yeah,
I mean,
yeah,
you
yeah.
have to consume
Excuse
liquidity.
me.
You have to take out the liquidity on the asset.
Yes, more market orders. So, sorry, I didn't understood that. But
Oh, sorry.
yeah, no, okay. Just make a short breaky. Does everyone understand what we are talking about here? Does everyone understand what we are talking about? My question was, if we see a volume spike here, what is needed to move the price higher? Yes, Chris, it seems, but it's really not. Therefore, we are talking about it because we see a big because we see a big volume traded at the top of a volume spike, or whatever you maybe even stop run. The price can't move immediately up because they need more buyers to lift the offer. They need more buyers. But on the way up here, there are a lot of anyway. There have been a lot of consumed volume, and that means it needs time simply either to find new buyers. If not, then the market will come back here. So every market move has its own acceleration factor, and what we want to see is the swing highs and the swing tops, the tip of the swings, where the price exhaustion happens. And when the price exhaustion happens, then be sure that the price needs time, or not the price. The market needs time to find either new buyers or either new sellers, depends on where the price is, to continue, or if they are not able to find new buyers, and mostly you will see such a behavior, and the price will drop down because there is a total exhaustion in this area where the price happened. No, not a vacuum. It's not a vacuum. We are talking about vacuum. We are talking vacuum. When we are talking about vacuum, we are talking about sweeps. Sweeps leaves a vacuum because they are consuming 1,000, 2,000 contracts in a few milliseconds. Okay. Not a volume spike simply exhausts because volume is traded up to there, and there are no more willing buyers in this case, in this example, in this drawing on the chart here, who are willing to buy, or who are able to buy, or who are able to consume everything on the ask here. Everything on the ask. Therefore, you understand that a DOM is an extremely important information when it comes to such, to these areas, to these extremes on the chart. We decided to measure the volume spikes or stop runs and to measure sweeps, because both of them has one characteristics. They indicates exhaustion at a low or at a high. It doesn't depend where they happen. Okay. Let's see. No. You see what what I talked about? If you put time price here and time axis here, then that was a clear accelerated up move. This accelerated up move needed time to recover. Let me say it this way. I don't know another word right now, but this very fast up move exhausts somewhere here. Then they are doing the second leg. Then these guys are coming up and selling. And what I wanted to show is, let me see if that works. No, that doesn't work here. It's going now when if you imagine here the time price axis here, it's simply going sideways here. So you will see that every single day we have a very fast move. This is the first leg. Maybe if you are with Elliott waves, that might be wave 3, then the reaction of the wave 4 here, and then you have the wave 5 here into the liquidity up. That could be another explanation for that. And and that was the question. To answer your question, Srini, you asked, a volume spike indicates as well as the price dynamics exhaustion. And where exhaustion happens in the market needs time either to find new buyers or sellers or whatever. And therefore, we just wanted to see these volume spikes, where the volume spikes are really of importance to us. How to set up. I will jump up. Absorption. I don't want to talk about absorption very long here. So absorption happens all the time when liquidity, so market order meets, or yes, collides with limit orders. I'm talking that this way because absorption happens all the time when, let me see that, when market order hits limit order. When market order meet or collide with limit order, absorption happens. You can measure every kind of absorption all the time on the chart here. Let me just adjust this a little bit here. Every time when oh no, I don't like this flags here. Let's a symbol is okay. I don't need anything else. Every time when market order meets liquidity, absorption happens. And you can drill down this absorption to 150, 100, whatever you want. You will have a bunch of signals on the chart, which I would not recommend because it's disturbing, simply disturbing.